At the beginning of the year, Tesla stock was named as a top pick by analyst Mark Delaney at Goldman Sachs. At the time, he cited that EV trends were poised to accelerate in 2022. Market penetration of new EV car sales in China had hit 20% at the end of 2021 and over 10% in Europe. But he observed that the US market share of EVs only resided at 3%, but new models such as the Ford F-150 Lightning, the Rivian R1T, and the Tesla Cybertruck would be entering the space in 2022. It's important to note, however, that more models will not simply increase EV share in the US. The Ford and Rivian vehicles are being sold at low volumes, whereas the Cybertruck has been shifted to mid-2023. EV market share has a much better chance of going higher due to production increases from mass market vehicles already in production, such as Tesla's Model Y and even the Model 3, which continue to experience output gains not only from Tesla's Fremont facility in California, but also Model Y has just recently hit a run rate of 1,000 vehicles per week coming from Giga Texas, which will be incremental to Tesla's US sales. Given the company's 75% plus market share of EVs in the US, Tesla is the real needle mover in the country and will continue to account for the bulk of EV sales, especially if the new Austin Gigafactory ramps up at a similar rate to Tesla's other factories, if not better. Nevertheless, a lot has changed since Goldman Sachs' analyst note in January, where Mark Delaney had just increased his price target on Tesla to $1,200, which works out to be $400 per share after Tesla's latest stock split. This past week, however, Delaney met with Tesla's Vice President of Investor Relations, Martin Viecha, and reiterated his bullish stance, but with a price target of $333, significantly below where he stood in January. The market has definitely taken a tumble since the beginning of the year as a result of contracting valuations, supply chain uncertainty, and a host of other issues, which could account for this 17% decline in their Tesla price target. But interestingly, Goldman Sachs brings up a variety of new reasons why they remain bullish on Tesla. They begin by saying that Tesla's costs per vehicle have fallen over the 4 years between 2017 and 2021 from $70,000 to $36,000 per vehicle, effectively being sliced in half. According to Tesla's VP of Investor Relations, however, in a more recent article, this is even more pronounced, falling from $84,000 in 2017 to $36,000 in 2021. This is mainly a result of transitioning the bulk of sales from the Model S and Model X to the Model 3 and Model Y, which have a design that's easier to manufacture, along with the new, more efficient factory design itself. These numbers have since been affected by inflation, meaning rising input costs and factory shutdowns, but over time they may be able to trend even lower, especially since Martin Viecha says that almost none of this decline in vehicle costs has come from cheaper battery costs, and so Tesla still has the opportunity to tackle battery costs with a 4680 cell and manufacturing lines that are in the midst of an aggressive ramp-up. Goldman Sachs also brings up an interesting point, which was that factory startup costs began showing up in the second quarter. These costs are more prominent when the volume is low at the beginning of a ramp-up. All of the factory's fixed costs for the quarter are not covered by the small amount of vehicles being produced early on. In my last video, I discussed how impressive Tesla's second quarter was despite an array of headwinds, and this is yet another one to add to the list that will improve significantly in the coming quarters as Tesla's volume from these new factories continues to rise. Goldman Sachs further adds that as Tesla's mix of vehicles shifts away from Fremont to its other factories, with Fremont being viewed as a converted ICE vehicle factory with higher costs, then Tesla's average cost per vehicle will come down even further over time. I'd also throw in that Tesla is upgrading Fremont to increase scale and efficiency using their new technologies from their other factories, which will also help Tesla continue along the cost decline curve. And by the way, stop using Yahoo Finance, stop using Google Finance, and visit our website, themarketisopen.com, for instant stock quotes and financial data going back 10 years, and it's all freely available. Goldman Sachs' Mark Delaney goes on to say that the Inflation Reduction Act could make Tesla a big winner in the EV space, even though there's still a need for clarification with regards to the new law. This is fascinating since it could have a major impact on Tesla's revenue with the new tax credits that they could get not just from passenger vehicles, but also from solar, batteries, charging, and commercial vehicles, as Goldman Sachs notes. Remarkably, there's much more certainty around these tax credits now that they've been signed into law, and how they could immensely benefit Tesla compared to what was known at the beginning of the year. Goldman Sachs even highlights that Tesla has more local manufacturing, one of the key criteria for potentially getting these new credits, than anyone else with respect to EVs, with the Model 3 and Model Y being the most American-made vehicles. So they already have an edge over other manufacturers to claim the highest amount of credits over the next multiple years, not to mention that this is also true for the aforementioned adjacent energy businesses. Other OEMs don't produce solar or battery modules, and most don't own their own charging networks. So Tesla benefits in all of these areas, yet it's intriguing to see that Goldman Sachs' price target is lower now than it was in January, being swayed by short-term market turbulence, despite some elements of their thesis turning out to be surprisingly good for Tesla. The third point is that Goldman Sachs believes that consumers will choose EVs in the same way that they adopted LCDs over CRT televisions and smartphones over feature phones. But the EV market could be supply constrained over the intermediate term as new batteries, components, and assembly take time to ramp up. Actually, batteries is the primary one of these that's going to truly cause bottlenecks for the industry. It already has, and stems primarily from raw materials that will be needed to keep up with the trajectory of EV growth. Tesla is already in the process of ramping up 4680 battery cell production. They've just added new machinery for this at Giga Texas, with efficiency improvements over the Cato Road pilot facility. This will allow them to anticipate massive future battery demand, but in all cases, they can only move as fast as the slowest part of their supply chain, and it seems that lithium refinement has been identified as one of the main future bottlenecks. Lithium itself is a common element, but refining it into automotive-grade material is where the existing industry lacks. Tesla is already taking steps in countering this shortage by looking at building a lithium refinery in North America, which could also further increase their chances of getting more tax credits as they are based on sourcing materials for EVs in the United States. That said, according to the conference between Tesla's VP of Investor Relations and Goldman Sachs, Viecha reportedly stated that for the first time I can remember, we can access all the supply we need for both businesses. And he's referring to batteries for the automotive and energy businesses. This is a critical statement since it could mean a relief in production constraints on Tesla's business, allowing them to unleash untapped production and a slew of new products into the market at a time when competitors are still highly constrained and struggling to shift their ICE businesses to electric vehicles. Viecha did continue by saying that for future growth, if the industry can 10x from here, the supply chain will need to 10x as well. And so supply constraints are not completely behind us, and there's still a lot of work to do to secure future production, but Tesla is investing in taking these actions today to be prepared for the years to come. And so circling back, Goldman Sachs' Mark Delaney actually argues that industry supply shortages are a good thing for Tesla as they support higher prices and therefore profits, just as we're seeing today where the prices of all vehicles, even used ones, have gone up dramatically in value given their scarcity on the supply side of the equation. Now again, Tesla does account for over 75% of the EV market currently in the US, which is a staggering number. So one way to look at it may be that Tesla is soaking up all of the resources, at least in the intermediate term, following what Goldman says, and that could keep competitor volumes relatively low and therefore pricing to be high. Tesla then has much more control over setting their own pricing accordingly, perhaps keeping it high to match competitors in the flow of demand. But this could really put a damper on competitors since they'll struggle to reach high volumes, and even as they do, Tesla has stronger pricing power given their much higher production capacity, so they can lower prices over time as the aforementioned costs come down, making competitor vehicles less attractive. But overall, Goldman Sachs, which has been a bull on Tesla, continues to believe that given Tesla's vertical integration, tight coupling in hardware and software, their charging stations, their brand, solar, energy storage, when you start listing Tesla's various businesses, there's obviously something very special at a company that's able to do this and simultaneously scale all of these things in unison. Goldman is focusing on the intermediate term, where Model Y from Giga Berlin in Texas will help Tesla expand margins, because these are high margin vehicles, higher than Model 3 actually, and it's the state-of-the-art version of the Model Y, which will take over Tesla's product line. And they also toss in that in the long term, Tesla will increase its mix of software revenue. Now, they didn't really talk about full self-driving, even though they briefly mentioned hardware and software coupling. But if they think Tesla's software margins will increase long term, then they logically must think that full self-driving must be coming. There isn't really another software product that Tesla has that could really move the needle, at least not in the vehicle space. So they think software revenue will come from somewhere without really mentioning FSD. They may not factor it in, it seems, but they must be at least looking at it as an interesting business further into the future. But this could be one of the drawbacks of the 12-month clock that analysts abide by when formulating their price targets. Enter billionaire investor Ron Barron, who doesn't need to report to anyone really, given his track record and long time horizon for investing. He's looking 10 years out on Tesla stock, having already owned it for the last 8 years and making 20 times his money on it, equivalent to about $6 or $7 billion. He echoes something that Elon Musk recently said, which is that he thinks Tesla will be the largest company in the world within the next 10 years, and states that he is so excited about this. Ron Barron thinks he'll make another 3 to 5 times his money on Tesla, which could push him to a 100x of his original investment. For Tesla to actually achieve this, their current $1 trillion market cap would need to surpass the Apple of today at $2.5 trillion and then hit $3 to $5 trillion, where Ron Barron's 10-year price target stands. That would mean Tesla would need to create $2 to $4 trillion of value for shareholders during this time. Now, in contrast to what Goldman Sachs' bullish Tesla note said about the company, you wouldn't have gotten that bullish Ron Barron type vibe by reading Goldman's research note. They're just looking at the next 12 months and have a price target about $30 per share higher than where Tesla is trading at right now. Ron Barron, who's spoken to Elon Musk many times in the past and has even helped to give him advice, he must see something in the company that the typical Wall Street analysts do not, or he has a more vivid imagination that allows him to look 10 years into the future and only envision what the world may look like. As a matter of fact, Ron Barron just purchased $100 million more of SpaceX stock, which he says may be the only company to rival Tesla's market cap in the second decade of the next 20 years. So what do you make of the investing time horizon used by Ron Barron versus Goldman Sachs? Most people get excited or disappointed when Tesla beats or misses their delivery numbers each quarter. But do you find it interesting that legendary investor Ron Barron is actually excited for his long-term 10-year investment? And if Martin Viecha is right about Tesla having enough batteries for both its core businesses for the first time, then what kind of EV production ramp do you think Tesla could unleash onto its ICE-powered competitors? If you enjoyed this video, have a look at my last video where I explain why I think Tesla's last quarter's earnings is very telling of how the second half of the year will play out. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.